Welcome, everyone. My name is Sandrine Zoku. I am the Executive Director of Invest Africa in the US. For those of you that are not familiar with Invest Africa, we're an organization that really helps to connect US investors to their counterparts in different markets in order to further their projects, further development of the African continent. I feel really excited today to be able to have three people who are not only going to be able to give us the investor perspective on some of those counter-cyclical investment opportunities that exist, but also the founder perspective as well. Tremendous experience. We're excited for a really lively discussion. So please start to think through some of the questions that you may have. As you guys can see, down below at the bottom of your screen, there's a Q&A tab. And so you can click on that. If you're interested in asking a question, we will have a portion for Q&A at the end. Feel free to ask a question, and then we will make sure to address as many as we can in the time allotted. And we can essentially get started. I will pass it over to you, Aubrey, who's this founder and CEO of Insider, as well as a board member of Invest Africa in the US. Thank you.
Thank you, Sandrine, and thanks everyone for joining us. As Sandrine said, my name is Aubrey Hruby. I'm a longtime advisor to investors investing in African markets. I've worked in the region for over 18 years and have worked across 35 markets. I have founded Insider, which is a PR firm that focused on working with African entrepreneurs and venture players to tell their stories. And additionally, also do some venture investing myself. And lastly, I'm a senior fellow at the Atlantic Council, where I head up all research on Africa business and investment trends. So really, I'm so pleased today to kind of coordinate and orchestrate our conversation. Rob and E are both good friends and fellow travelers across the region. Rob's joining us from California and E's in Lagos. And really want to set the stage for our conversation today. Today, we heard that the World Bank has projected a greater decrease in African growth than we had originally heard a few weeks ago, when the UN ECA or UNECA had forecasted a slowdown of growth. Now the World Bank is talking about the first recession in African for the first time in 25 years. So they're talking about a contraction of growth of potentially up to 5% for the region. And this is a region that's been the fastest growing for 2 decades when you look at Ethiopia and Rwanda. So a significant change on the macro front. And in the last couple of weeks, we've seen major calls in the FT and globally for debt relief made by Tidjane Thiam, made by Ngozi Okonjo-Iweala, and other prominent African leaders, basically explaining that without debt relief or a moratorium standstill on both public and private debt, African countries won't have the fiscal space in order to respond to the crisis in terms of any form of stimulus, etc. And so we're seeing that on the kind of macro level. And obviously this fitting into a global crisis. I think for the first time in human history, we're having an experience that's truly global in nature and similarly in global in nature. So, in World War II was global and happened in so many countries, touched so many countries, but the experience of it really depended on where you were, whether you were in Japan or Algeria, you essentially experienced it very differently. Now we're in a moment where we're experiencing more or less variations of the same thing, staying at home, hand washing, social distancing, across 200 countries. And so for the moment, we have a situation that is economic, political, and social, and questioning whether we're going to see kind of a new world order after this, depending on how long it lasts. What is for sure is the COVID crisis is reinforcing some trends that we've seen and fast forwarding others. So a friend of mine keeps saying we're fast forwarding the future. And really the future has been Africa for all of us. And so that's what we're talking about today. I really want to jump in and make sure we hit multiple asset classes, but I will say from the offset that E and Rob and I obviously share a passion for the venture space. So we are going to be speaking a lot about venture opportunities, but we will try to hit on private equity and debt and emerging market equities, public equities as well. So let me stop there and let Rob and E introduce themselves. and then we'll jump into kind of the view from each of our perspectives. So I'll start with Rob.
Great. Thank you, Aubrey, and thanks everyone for joining us. Yep, I'm dialing in this morning from California. I'm part of the team at Lateral Capital, and we're a venture fund that invests really in technology for critical infrastructure. My team is spread out between Nairobi, Lagos, Johannesburg, and New York. And what it is that we do is try to be a life cycle financing partner for companies that are delivering on really what we think of as the pillars of prosperity for the African continent. We've made 13 investments. We typically invest sort of from seed plus stage all the way through to post Series B. And we've really built Lateral to try and meet the market where it is today, meaning we do debt and equity. Aubrey, you've already touched on a couple of very exciting points. I think my departure point would be two responses. One is, yes, of course, this crisis is taking us into completely unknown territory. Having said that, innovation in Africa happens in a capital vacuum, in an infrastructure vacuum, and really venture in Africa hasn't been cyclical yet, because at the most optimistic estimate, $2 billion went into the space last year. Yes, that's up 5 to 8 times from 4 years ago, but it's still really a drop in the ocean. The second point being, I think it's really important when we talk about Africa to really engage with the continent on a city level, which is how we look at it, and think about how's this going to play out in Lagos? How's this going to play out in Nairobi? How's this going to play out in Joburg or Cairo? Rather than sort of purely from a top-down perspective, thinking about what the slowdown might mean or how to interpret macro. I'll pause there and let Iyin introduce himself and we can pick it up again.
Sure. My name is Iyin. I am a general partner at Future Africa. Prior to going to co-found Future Africa, I helped co-found Andela, as well as Flutterwave, which are very well-known high-growth technology startups on the continent. At Future Africa, we partner with innovators who are building an African future. And we do this by providing them with capital, up to $50,000 for between 1 to 10% of their company. And coaching. We typically have a whole plethora of resources and office hours that we support our innovators with, as well as a community where we bring together government officials, large corporates, talent, and practitioners in the industries that they're working on and problems they're trying to solve, and then put them together to essentially grow their businesses and solve the problems that they want to solve. Ultimately, the reason why we do the work we do is because we believe that by backing innovators who are turning our continent's largest challenges, most difficult challenges, into great business opportunities, we really have a potential to build an African future where prosperity and purpose is within everyone's reach. And very much like what Aubrey said, I think I put out a note to our community this morning, basically saying, you know, once you look past the gloom and the doom, what you really just see is the future we've all been waiting for. So I don't necessarily share UN. I know they're all economists and they're supposed to be smarter than us, but they've been wrong so many times that I have no belief in their estimates. I think this is really going to be the beginning of an African future if we take the right steps and we mobilize our capital, our intellect, and our resources in the right way so that we can create a new future, a digital future for our continent. And what's happening right now is social distancing is just bringing that to life much faster than we thought.
Yeah, so I think I mean, that brings us to a good thing, which is a good point, which is, you know, the COVID crisis is either reinforcing certain trends we've seen in the past and maybe speeding them up, or they're breaking trends. And so one of the trends that we have seen growing over time is a kind of switch to the digital space. So I think mobile money, for example, we've all been following the success of M-Pesa since 2009, and growth of mobile money options. In many ways, this is going to speed up mobile money. We're seeing it as fees reduce. Cash is dirty. It's not clean. It's not sanitary. So, you know, can we see this as fast forwarding a mobile money perspective? And so I'm intrigued in from both of your perspective, which trends COVID is accelerating and which kind of other trends is it breaking?
Yeah, go ahead, Ian.
You go first, Rob. No, you go first.
Sure.
You're the one investing in infrastructure.
Where I was going to go with that, Aubrey, is if we think of this from, I think at a very high level, people call this the greatest urgent digitization in the history of our species. Never before has it been this important to take anything crucial that is offline online as quickly as possible. And I think that obviously sounds nice, but tying that to the reality of the challenges and constraints of being online in Africa goes straight to logistics and goes straight to some pretty critical infrastructure challenges. Even though we've seen some incredible technology emerge and couldn't be more excited about the growth, the average Lagosian still has enough central grid capacity to have a 60-watt light bulb powered for 45 minutes a day. And so you can't take power online at the click of fingers. You can see a lot of human capital verticals racing to be online, and fintech is obviously leading the pack. The point that you make around what the barriers have been to bringing some of this technology fully online, I think takes us straight to three things. It takes us to logistical infrastructure constraints, and we can get into e-commerce and sort of last mile challenges there that mean that ordering his food online happens much faster than it's ever happened before, but those rails still have to be built. Secondly, we're talking about a very fragmented response. And there's a reason why fintech has not scaled across the continent the way that many people think. And then thirdly, there's always kind of the natural barrier, which is regulations and what it's going to take. In the US, we've seen some real fast track legislation changes and regulatory changes that have led to initiatives like small business access to finance. And we can maybe touch also on if there's any hope of sort of regulatory fast track during this crisis.
Yeah, and Rob, question there. I mean, you've drawn analogies to the experience of Alibaba and SARS. Maybe you can talk a little bit of how we saw this fast forward in Asia during crises.
Sure. I'd very much hesitate to say that Africa is going to have its Alibaba moment because of this crisis, because e-commerce is clearly going to look very differently. I think most people on this call probably sort of look back and seen that during 02, 03 and SARS, the adoption of e-commerce really skyrocketed out of necessity because those businesses started to provide, cheaper Chinese goods to the US and that fell away. I think the African analogy here, and no conversation is complete without talking about Jumia and the fortunes and misfortunes of that model of e-commerce. But to me, the moment that Africa and the cities that we're so excited about has here is to solve for existing retail formats. And there are a couple of examples on this on the continent. We invested in a company nearly 3 years ago now that provided a very basic initial human need category, which was cooking fuel, which doesn't sound that exciting maybe if you're sitting in New York or London, but happens to be the third biggest spend category in Nairobi after food and airtime. And that business's success has really come from the fact that it acknowledges that people typically shop every 3 to 4 days maximum, 300 feet from their front doors in existing retail formats. And I think what we'll see is a rush to plug and play with existing infrastructure. And that's how venture happens in Africa and should happen, is by tying together legacy infrastructure and making it work better, not just sort of purely for the sake of disruption. I'll pause there and we can sort of get more specific about companies, but the key point is we will leverage our legacy infrastructure and innovate around that following this crisis to perhaps get there faster.
I mean, you've been helpful in building some of that legacy infrastructure, at least on the fintech side. So what are your thoughts on the potential to fast forward e-commerce and the digitization effort?
I think we're already seeing it. I happen to have a slightly different perspective from Rob in terms of the reliability of the existing infrastructure in the first place. It never really worked well, but just because it was what most people could see, where they had to use it. Unlike most other countries,
what do you mean? An example of that?
I mean, a practical example is like it never worked well for markets, open markets. Never worked well for anybody. Both for the traders, both for sanitation, both for local authorities, never worked well. They were always a nuisance. That's why they kept burning down. And now we have an opportunity because of health risk, which is a very important reason for a lot of people to move, for them to now move to this much cheaper, likely much more efficient mode of distribution. Now, will it involve some sort of infrastructure that already exists? Perhaps, right? But I can bet you it's going to be way more organized, right? And it's really going to rely on our ability to focus innovators on these problems and get them to put out great solutions, logistical, technological, and otherwise, to these challenges. And the quality of ideas that we are able to implement at this time will really determine how quick the shift actually happens. But we have a fantastic sales rationale, headline screamer, which is literally physical contact will kill you. So here's a beautiful reason to go digital, right?
Not only kill you, kill your grandma.
Huh?
Not only you, kill your grandmother. So like
no one wants to kill your grandmother, kill your child. And I think that's going to be what really accelerates the progress that we've already started. Spar is a business I talked to when I was CEO of Flutterwave, and they kept us at bay for a long time. We told them, come e-commerce, never agreed. Guess what? 2 days ago, we've gone e-commerce completely. And it's only a matter of time before ShopRite follows, right? It's only a matter of time before the market association in Mao 2, which is the largest food market in West Africa by any stretch, literally went e-commerce.
And how did that work? I mean, listen, 90% of Nigerians buy their food at open markets, right? And they have people in their house that do that. So, you know, there's always been this stickiness of the informal sector when it comes to the grocery space in Nigeria. And that's why, you know, Massmart and others had problems because A, not real estate, but B, there's a sticky behavior when it comes to the informal market. So how are you seeing informal markets go online?
It's a cost question, right? It's a cost question really when it comes to open markets versus real estate, cost and logistics, right? Because the reality is that the food comes from the outskirts and the malls are right in smack dab in the middle of the city. Well, e-commerce kind of compresses all of that because now you can actually have real-time routing and logistics that allow you to do low-cost routing and move food where they belong. Now, am I saying that this would happen tomorrow? No, but there is now an imperative for people to innovate in that direction because innovation is what really brings down the cost. It doesn't just happen. Innovation would enable people. People now have a reason to innovate and figure out how to make this work because we have to or we die.
Yeah, just taking off from that last point you made, I think the other aspect here that innovation needs to focus on is the customer that you're servicing. And very specifically, you know, to make the unit economics and the technology rails work to get products and services to a customer in Lagos, to a customer in Nairobi, to a customer in Joburg. I feel that sometimes people assume that the exact same models that, you know, we've seen in other venture capital ecosystems will apply there without being mindful enough of what customer needs, the customer basket, and commerce behavior looks like. And for that reason, I think it's really important to, you know, you mentioned cost, to figure out, your Spar example is a great example. This isn't going to be one Amazon that owns the whole chain, vertically integrated, just trying to, you know, increase the.
Why couldn't it be? Why couldn't it be? Right now, I mean, Spar makes billions of naira a day, right? There's no reason now why to keep their business alive. They're not going to invest that money, right?
Because they haven't
making sure they can build that supply chain.
Because they haven't invested in the logistics yet. And so what I'm saying is there'll be another actor in that part of the supply chain, and you've already seen, you know, that happen. Some valuable companies have been created in last mile logistics. My point is just the only focus isn't e-commerce own the customer start to finish. There are opportunities to build great companies that plug and play and deliver this because of the cost implications. So the why is because they can't afford to.
Well, maybe we can, and this is the moment to talk about Jumia. I mean, some are saying with Rocket selling their shares and, you know, Jumia trading at, I don't know, pennies on the dollar now almost. What do you guys think about the future of Jumia? I mean, this should be the Jumia moment, no?
It is the Jumia moment. I'm glad they sold because it means they're going to do all the work and get none of the benefit. It is a Jumia moment. I've always believed in Jumia. Do I think the management was always the most competent? No. I think a lot of the international management didn't really understand the market they were in. Some of the local guys really did, but a lot of the international guys may not quite have gotten it. And I know how much I am depending on Jumia in this time. So I can tell you for free that there are people depending on Jumia in this time. When their warehouse was shut by the government, they had to open it in 24 hours because people needed this service they were providing. So this is a completely different time from your typical, you know, and there's a lot of like tech pessimism that has typically taken shape with a lot of like PE trying to come into VC investors, trying to value back the entire ecosystem. I think a lot of that is going to go out the window. We might not see the results in the next year or two, but I'll tell you, in another 4 or 5 years, we'll be having a completely different conversation about value.
But I don't think it'll include Jumia because I think this is Jumia's zero moment. I think from the ashes of Jumia, some really interesting companies can emerge, but they'll be built with unit economics in mind that makes sense for where they work. And by the way, it doesn't have to be one player. Very valuable.
Look, it cannot even be one player. It can't be one player.
No, it can't be one player. And the Jumia of Cairo will look different to the Jumia of Lagos, will look different to the Jumia of Nairobi. I think an interesting company to look at in the space in East Africa is Copia, which understands how to leverage the trust network of, you know, agent commerce. And it is also able to plug and play with existing retail formats where if you're a rural customer and you currently shop at a small commerce outlet, Copia's model is to use that as your logistics rails and service rural customers by partnering with other parts of the value chain.
How is this different from JForce? I still don't understand how people see Copia and don't see JForce. I don't get it.
Because Jumia's, you know, put capital into so many other aspects of its business that aren't profitable. That, you know, JForce can be a standalone company, and that I agree with. You know, this could be a JForce moment, but it's not going to be the house that Jumia built with all the verticals firing on, you know, on their cylinders.
I don't know what form it will particularly take. I can't say. No, neither can anyone. But what I will tell you is, in these moments, innovation is literally forced out of companies that are ready for it. And
well,
I
it
think
it is a Darwinian moment in that, you know, those who innovate will live and find that product market fit right on the edge, and those who don't.
Exactly. And I think it would be such a shame and almost frankly difficult to believe that, especially with Rocket out, because I always thought they were a bad influence on Jumia, they wouldn't be able to survive this. I would be very disappointed if that happened.
Maybe we can switch a little bit to the real asset aspect, because, you know, one of the things everyone knows is Jumia is selling a lot of imported goods on its platform, right? Most of what you're buying comes from outside of Africa. So the question is, if one sees the COVID crisis globally as kind of working against globalization and working for kind of state autarky or ability to kind of self produce things, then I think essentially we have to ask, you know, what about farming? What about getting local goods into country and better distributed? We've long known that Nigeria produces an enormous number of tomatoes in the north, but then imports tomato paste in the south. We know that there's all kinds of inefficiencies, and that many African markets not only skipped industrialization, or you can't say really leapfrog in this case, like they actually deindustrialized compared to 1980. So in the like industrial goods, we're talking PVC pipes, we're talking real economy things, there hasn't been the investment. So, you know, a Jamia and others are going to have to sell things, and where are those things going to come from? And so what are you seeing about investments into kind of real assets?
I mean, what I believe is that a number of, I think distributed manufacturing is going to be the name of the game. I'm not really seeing a scenario where you have these big, large manufacturers really survive, in my opinion. I think that what you're going to see is a lot of, like, just like you have in India, small distributed plants, primarily servicing their community, because more people are just able to make what matters. And then maybe a few commodities may then be made at scale where there are efficiencies to be gained by doing.
Which is obviously not a new idea. I mean, cottage industries was the beginning of industrialization in the West, exactly. in UK, and other places. So, you know, decentralized manufacturing was kind of where industrialization came in, because we wanted economies of scale. And one of the issues in African markets is that scale is hard because of the fragmentation across the region.
But Aubrey, the investment community is also at fault here, because unfortunately, there's still a perspective that venture looks a certain way, and that, you know, obviously it's exciting to invest in single product hyperscale companies where you put some rocket fuel in every 18 months and, you know, hope for 2 to 3x your valuation, without realizing that, you know, in Africa, companies inherently tend to be more profitable and don't just prioritize growth. And that applies to real assets, because there is a huge space for, I won't even call it venture, but investing in innovation through hardware and asset-backed, you know, infrastructure solutions. Sometimes that means—
give an example of that, Rob.
Absolutely. We invested in a company 2 years ago called SparkLeader that is a hardware and software solution to grid reliability for power. They produce with an IoT radio mesh network grid monitoring that allows both, you know, large central grids as well as smaller microgrids to reliably collect payment, but also monitor their grid strength and continue to invest in that grid. And so there's a hardware component here. There's also a SaaS product that sits on top of it. And at a stage, you know, growth is tremendous for this company, but it looks different when you're financing a greater proportion of that hardware risk. And so a company like that may actually need investors to step in and be hands-on and say, right now, there's a great use for debt, or the scale effect here is going to come through hardware first and then really through SaaS product that you're investing in. So this is where I almost feel like we shouldn't fall into the cliche of, you know, what is venture in Africa, and just really be focusing on building, you know, and backing innovation, however the market needs that to happen.
It's a critical point, because, you know, you haven't seen a single country in the world develop through asset light investing only. Like, what country is just asset light and that's how you just can live, right? We need some real assets. And I've always argued that, you know, you have the spectrum of check size, more or less, and that's what defines venture versus private equity in Africa, is just a function of check size. If you limit it to, oh, we're only doing tech companies where we can exit at, you know, you're not going to get valley results anyway. So yeah. That's just a reality.
If I can say something though, I think it's very important to define tech as different from innovation, right? For me, what I find interesting about the way the traditional PE guys typically invested was they listened to UN ECHA reports and all these professorial guys sitting in New York telling them what the market is. They didn't listen to the streets. They didn't want to hear from people on the ground, innovators on the ground, businesses on the ground. And those who did are successful, and those who wanted to sit down with McKinsey reports and let that determine how they invested, had ICs that were too restrictive, limited partners who'd never been to Africa, but wanted to make decisions about investment in Africa. Those are the guys who lose out, and it shouldn't surprise anybody. It shouldn't be our loss as Africans that they lost their money. Of course they lost their money. They didn't know what they were doing. And it will always boil down to that performance. And for me, I would say that sometimes people make a lot of broad-based statements about, you know, what kind of investments should happen where. I'll tell you for free, right? Look, the vast majority of manufacturing on the continent, the results of it are in Nigeria, the asset management company of Nigeria, right? A 5.2 trillion naira debt, you know, blob, because this big manufacturing is not innovation. It isn't. It never works. And I think, you know, one of the books that has really inspired our work is The Prosperity Paradox, the last book Clayton Christensen wrote before he died. We're all imagining we're going to create these efficiency centers and all that stuff. Meanwhile, innovation is what is required, right? Innovation is what is required. So I would say it's not even about, in my opinion, whether it's technology, asset light or not asset light. The question should be, what problem are you solving? Are you really solving the problem? If you're not solving a problem, if you're not making housing cheaper for Africans, you're not solving a problem, right? Yeah. if you make sense, right?
That's a great example.
And if you're manufacturing soft drinks and you're not making food cheaper for Africans, you're not solving a problem. Yeah. You're going to need government support to stay alive. So we need to refocus on who's solving the problem and who's not.
So let's talk about some of the big, I think, really exciting opportunities to solve some of those problems with innovation, right? And some of these are maybe pretty boring sounding problems, but, you know, outside of SA, mortgage penetration in Lagos and Nairobi is less than 5%, right? And and that's a problem that people, you know, need to really focus on and innovate on to unlock the mortgage market. You know, that's the greatest piece of prosperity that, you know, that can exist, is being able to have actual access to financial products built on top of having access to that asset.
It goes back to DeSoto's work on unlocking capital, right? You need your deed, you need your mortgage market.
Absolutely, but that, you know, there's a blockchain application there potentially, because land registries, you know, in some cases, a federal and a state, or a county and a state level land registry doesn't even agree with itself, right? So there's a technology solution there. Digital identity, I think, is one of the most exciting problems on the continent, because, as you know, one of my partners, Barbara, always says, every business is a fintech business in some way, shape, or form, and bringing that level of plug and play access to the ecosystem to consumers is crucial. So I think these are innovation problems that will have a combination of online and offline solutions, but I would focus there following this crisis, because if you want to, you know, build innovation that's worth billions of dollars, let's solve problems that affect you know, people.
I mean, I think what E is saying, and I see it all the time, is that you know, traditional venture investors are not, they're micro risk focused, right? They're focused on the entrepreneur and their ability of that entrepreneur to operate, to execute, right? Whereas private equity investors are macro risk often focused, because not the nature of their LP base, but also your ability, the currency risk. Currency risk is a real risk across African markets if you're thinking about getting your money out in 5 to 7 years. And so, you know, and you're investing in dollars. And so this macro risk versus micro risk focus is one that I see a big difference in the type of investor that is focused. And there's historically been this conflation of macro or headline risk with counterparty risk, even in the private equity space, and people focusing too much on the macro risk and not enough on the headline risk. Now, obviously, if you're investing in something that needs the whole economy to grow, so, you know, for example, Indomie noodles, right now you probably need Nigeria as an economy to grow for people to buy more and more and more and more people, for example, because right now you're not unlocking a whole new market, which is what he's talking about with the you know, prosperity paradox, is you're actually creating a market So you're unlocking something internally that wasn't there so you can grow for a long time. I mean, we saw that with Cars 45 in across African markets, where you're essentially in a used car, you're creating trust in a way that you actually unlock a market, trust and transparency of pricing. You unlock a market that wasn't there in the same way. It was informal, but highly, highly inefficient. And so that innovation unlocked the market as a whole. And so one of the questions I think we've had several times in our chain, and just to our listeners, we are watching your questions, is one about housing and infrastructure, physical infrastructure, and what to do about those things, and whether the crisis will affect innovation in those spaces.
Personally, what I think is going to happen with housing and physical infrastructure is that I don't really think the assets themselves need any change. I think the innovation has to come from how they're financed. And there's a lot of trust in, I mean, the first thing you mentioned when you talked about it was the mortgage market. We don't need a mortgage market in Africa. The mortgage market is in the time it takes to build a house, right? And it's simply a question of, okay, what physical guarantee does one have against the instrument, right? Because you know you're not going to be able to build a house in that short period of time. How do you actually get some credit to be able to continue to pay for the house? People are innovating these things every day. When they ask you to buy an offline house and pay over a period of time, these are problems that are being solved. People are just ignoring the solutions because they don't look like what you have in New York or DC. You know what I mean? Landway is an amazing business, making millions of dollars selling land and mortgage properties online. But then they don't look like something that has mortgage backing. But they're working. It's working. So I think it's really going to, at the end of the day, I sound like a broken record repeating this, but it's going to be about the financial instruments that are innovated to support these companies, right? It's about who's going to innovate on that level. It's rarely going to be, honestly speaking, about whether you bring in some mortgage market or blah, blah, blah. It's about what's working in this environment, because people are already innovating, like you said earlier, Rob. They're innovating without infrastructure, without rule of law. They are solving their problems. So are we going to be perceptive enough to look at what they're already doing and figure out how we can scale what they're already doing, as opposed to thinking that, you know, the white man's way is best, or it has to come from DC and New York, World Bank has to endorse it, and UNECA has to say it's right before it's a solution. And I think that's where we're going to be able to distinguish between the venture capitalists who know what they're doing and those that are simply going to flame out again at the end of this crisis.
I think maybe one thing that'll come out of this crisis is we won't get sort of stuck in semantics, whether you want to call something venture capital, private equity, or, you know, whether you want to call it solving for the mortgage market or not. It doesn't really matter what language you use. It's about unlocking the potential from the bottom up at a city level in Africa. And again, the solution is going to look different everywhere. I also don't think it's about macro or micro or New York or California. It's just about being real and unlocking the potential of the continent from a solution that plugs and plays, respecting, you know, all the constraints in any geography you invest in. You don't have to call it the mortgage market, but you can call it access to real assets if you want to. It doesn't really matter. But I think a good place to go with this is, one of the biggest constraints is access to finance and really trust. And I know with Flutterwave, you know, there was a lot of thinking around how can you decrease friction, of course. I think a frustration for a lot of investors, no matter where they are or what you want to call them, has been how do we scale fragmented and siloed infrastructure in the financial services space, because you can solve for housing, you can solve for power, but at the end of the day, finance matters. And so I think it would not be a complete conversation to kind of talk about where that's going next as well.
E, do you want to comment on the Flutterwave point? I mean, listen, my perspective is, listen, private equity investors and venture, we're all doing growth equity. You're all trying to help companies grow and having different tools. Unfortunately, LPs often make you pick a bucket, and everyone knows that from a reality of fundraising, and who are on this call, who are not blessed with, you know, inherited tons of money or something of that sort. You have to go and raise the money, and you have to pick a bucket.
Yeah, Aubrey, I think that's going to change. I'm making bold to say LPs will be irrelevant by the end of this decade. And I'll tell you why, right? Like, it makes no sense to me that I got to go meet someone in New York who doesn't understand my problems, doesn't know what I'm going through, isn't a customer, and wants to maintain strict control over my investment process without acknowledging my experience, right? And is taking a fee from some other bigger partner, probably a portion of my GP. I mean, these are all very technical terms, and we probably should talk about them here. But I make bold to say they will be irrelevant in a decade. They will be irrelevant.
Well,
and
we've certainly not seen
happen,
DFIs as LPs become irrelevant. I mean, DFIs, the development finance institutions, started the private equity industry in Africa, and you see certainly what we're going to see in the short term is that the funds that are out there raising, and many of the people listening might be out raising funds, in the short term, DFIs will play an even more outsized role in.
I doubt it. I doubt it as well. I doubt DFIs will be relevant in a decade either. And I don't know about them, but I can tell you for sure LPs will be, but I don't know about DFIs, right?
Well,
and
DFIs are the LPs. For most African,
well, maybe.
If you look at a fund like Catalyst or something pre-2008, they had about 60% of their fund LP base being DFIs. And then when the crisis hit, their next fund, the percentage was up to 80+%. So what you essentially
you know what wasn't around then? What wasn't around then was infrastructure for aggregating capital. We have that infrastructure today. I can go, and I am experimenting with this. We just launched the Future Africa Collective. And with the Future Africa Collective, we're going directly to the people who have cash and do not trust financial institutions, again, to allocate their capital where it matters most. They trust their own judgment. They trust the judgment of specific GPs who have experience. And I am making bold to say, I think that's really how fundraising would happen in a decade. I may be wrong, maybe completely wrong. But today, as of today, we have 100 people signed saying, hey, we want you to invest our money directly into startups. So I'm not talking to any LPs. I'm unlikely to need to. Maybe a few who are mission aligned with me, but I can bet you that might be the way we all fundraise in the future. Directly, we go directly and put our results down. Not about the relationship with some DFI. Huh?
Again, though, I mean, let's not die in a ditch over, LP funding or relationships or anything like that. I think coming out of this crisis, right? Coming into this crisis, if you ask me what's the thing that surprised me the most, having been, working with founders and building companies for the last 8 years in Africa, I would say to you, before this crisis, what surprised me the most was the amount of interest from large corporates looking to buy innovation in Africa. If you told me 8 years ago that we would have no less than 5 Fortune 500 companies and a lot of local giants looking to invest in our largely pre-Series A, but definitely pre-Series B portfolio, I would have said, get out of town. And it's going to take a while to get back there because everyone's cut R&D budgets, everyone's cut, focused again on priorities at home. What comes out of this crisis is going to be front and center for people that need to buy growth, whether there's a recession and continent-wide forecast or not. Let's not focus on the next 12 or 24 months. 4 or 5 years from now, large price tags are going to be achieved. Companies that can innovate and scale that traditional corporates are going to be looking at. And I think whether you manage DFI money or traditional money or crowdfunding, you still have to create exits. Companies need to be sold. And how that's going to change is something that I think about a lot.
Yeah, so I think listen, we are getting to a point where I want to address several questions at once that we're getting. And I want to be able to ask you guys what you are looking at investing in the near term. Some questions that we're getting, and I'll toss them out and then everyone can kind of address a few of them, is of course the role of crypto And is this a moment for crypto to really grow? And then secondly, a question around health tech, telemedicine, things like ed tech are, everyone is talking and writing about these sectors right now, but is it really a movement that we're going to see a ton of investment into the space after or during and after COVID? So those are some questions I'm seeing. I don't know, Rob, E, if you want to take a couple as we respond and start to wrap up our conversation.
I think on the question of crypto, there is a role for crypto to play in this crisis. And we're heavily pushing with the government and the regulators saying, look, think creatively about quantitative easing. Instead of doing what you normally do and giving big chunks of money to some big, state-sanctioned capitalist who's going to take the money and go use it to buy houses in London, why don't you give this money directly to the people as crypto, right? As digital currency? You can set a different kind of exchange rate for it because you can control the money. You keep it fully electronic. It cannot be exchanged at the same rate as normal cash can be exchanged. And you can send that money to 70 million people. Even if you send 5,000 Naira to 70 million people, the economy will feel the impact. And digital payment platforms can process the payments. And there are places where you can go and buy supplies for this payment. And maybe there might be differential pricing between what you can buy for digital currency and what you can buy for real currency. But that's an innovative way to reach everyone instead of carrying cash around, and spreading more germs, cash. And this might be a very fast way, actually, for all of us to be able to accelerate into a digital future. We need to be looking at crazy ideas like this. And it's going to be the bold leaders who decide to go after crazy ideas like this that are going to come out of this looking like geniuses.
Well, I think it's important to differentiate between crypto and blockchain. I mean, as it stands, Africa is the biggest mobile money market in the world, and that doesn't look the same everywhere either. I think you can get money to the people without having to build crypto. It might make sense in some cases, but I think the potential of blockchain to solve for trust issues and friction is really exciting. I think he pointed to the biggest challenge with large-scale adoption, which is regulation. It's not an African situation; that's a global situation. Increasingly, what's exciting for me is there is a lot of buy-in to the idea of even sometimes totally open source blockchain solutions, like in the banking system. One of our companies has successfully piloted open source blockchain clearing product for commercial banks. And the cost savings on that for a bank that is trying to service its customers is in the region of 80%. So that's a game changer. You're taking friction out. Aubrey, you mentioned EdTech, and I'll just finish there. I think the challenge with EdTech has always been that, globally the price of content is tending towards zero, right? There is great content online pretty much for free. It's about the rails to get that in a format where it can be micro accessed, probably on smartphones and tablets rather than web-based, and specific to an outcome. So to solve, I think vocational is the most interesting, like bringing the potential to micro learn post-tertiary or post-school will be huge, but it won't be in content creation, it'll be in content delivery.
And Rob, on that, maybe we did have a question too on human capital and kind of like how you kind of find talent and mobilize talent. I know you guys invested in Link in Kenya. Are they thinking about connecting people to talent in different ways now?
They are, and the other company I'd throw in there as well is Seamless HR, which is one of the companies I'm the most excited about in Nigeria right now. The problem that Link is focused on solving is trust, and it's about using an endorsement from users, no different to trust platforms, in other markets, to unlock skills and products. But I think the way to build a valuable company, there's really in investing in the capabilities of your workforce. In the case of Seamless, what's so exciting about what Emmanuel's building there is you're creating so much efficiency in a very inefficient sector, which is workforce management. But importantly, you're sitting on phenomenal data, cash flow data of employees that should have access to financial products. And you've given a better proxy for solving that trust issue than scraping maybe a smartphone or, you know, GPS data and purchase data.
Yeah, and E, I want to bring you here because, you know, you and I have talked and been friends for a long time, and I always appreciate your radical thinking. But the greatest asset you always talk about in African markets are the people and the human capital piece. So, you know, how are you seeing ed tech, creative industries, human capital talent piece during this COVID crisis and beyond?
I think one thing I'll make bold to say is that corporates are definitely going to need to turn over their workforce. And they're going to realize they need a completely different set of people to operate in this new world. And I think that's the greatest edtech opportunity right now, is in preparing the workforce for corporates about how to operate in this new world and what kind of skills they need to operate in this new world. And that's why, you know, teaching fourth industrial revolution precept to Africans, teaching data analysis to Africans, teaching Africans how to code, teaching Africans how to build new kinds of supply chain and logistics. That's going to be a rave right now. And the edtech companies that are focused on that, alongside providing basic numeracy, literacy, and critical thinking and reasoning to young people, and providing people the ability to work on projects now that literally everybody works online. That's going to be where the edtech companies that really create value are going to focus. And so the way I look at it, there's a greater opportunity in edtech, but if you put on the hat of the current times, quote unquote, as opposed to the hat of the post-COVID world, you're going to have radically different results. This is probably time for an Andela 2.0.
Yeah, that's what I was going to say. So what does Andela 2.0 look like in your view?
I mean, one is distributed. We definitely will not do what we did in 2014, where we brought people together. And the learning community is a reasonable prototype of what that looks like. No physical buildings, but has graduated, has had about 33,000 young people participate. Over 200 young people have received certificates. A lot more have received jobs just from that opportunity. What does that look like at scale and for different skill areas? That's going to be very interesting to watch. And then I think distributed work as well is going to be another corollary. So rather than depend solely on our US clientele, what would it look like when corporates are going virtual with their workflows? How do we manage that? How do we create new workflows that engage them and manage that? So I think that's going to be very important as well.
Yeah, well, we're nearing our last few minutes here, and any pressing questions from our audience, please get in. But I wanted to finish up the conversation by asking you both, you know, if you had $100 million fund starting on May 1, what would you invest in and where? And secondly, also for those who are looking to make private investments of, say, let's say $20,000, those who want to be angels, what would you do and where? So the 100 million level, how would you kind of think about big acquisitions, and how would you do, you know, advise an angel investor that is interested in getting their feet wet maybe for the first time while prices are cheaper? So I'll start with Rob.
Sure. You know, Aubrey, I don't think we'd be doing much different to, you know, what we're doing now with you know, with the capital that we manage. And the focus really will be on continuing to build rails and decrease friction to layer products and services on top of platforms. We think the tremendous opportunity here that looks different to the Valley is you can be more bold in having multiple products and services that really fill an infrastructure gap.
So could you give an example?
Yeah, sure. You know, I think the best example of that is one of our portfolio companies, AppZone, in Nigeria, that have really, you know, solved for 6 different, very large constraints that Nigerian banks have, which include digital channels, encryption, clearing and switching, and then P2P merchants payments. And that looks like an operating system. So you can have the whole platform, and you can really be a virtual digital financial fintech or bank. The idea there is banking in Africa, retail banking is the second most profitable region in the world, but access to finance is 35%. Something's very wrong there. Something's very, very wrong there. And there's tremendous.
A lot of people making lots of money then, huh?
No.
Buying government paper.
Well, there you go. That's the problem, right? Is that like finance is broken in that sense, and it's about taking out friction and providing the rails to really get behind SMEs. Let me be frank. SMEs are the opportunity. Technology is the solution, and you can kind of recalibrate which vertical you want to look at, but it mostly comes back to that for us over and over again. And so the opportunity is not to be prescriptive and say this is how it looks in Latin America or Asia or Europe. The opportunity is to apply that mindset at a city level and say, what does Lagos need? What does Nairobi need? And then build the bridges between those ecosystems.
Great. Well, besides telling people to invest in the Future Collective, which I know you will, what else, what would you buy right now? Maybe your own city. We've talked about future cities. We've talked about all kinds of bold things, but then also how can angels get involved during this time? One of the things that I always think about, because everyone says, oh, well, everything's so cheap, valuations are coming down, you're going to see a surge of investment. And I've now ridden out 4 economic downturns in African markets, and I can say I don't ever see this rapid influx in, because often what happens, the people who have the liquidity don't have the risk tolerance, and the people who have the risk tolerance don't have the liquidity. So often that's the challenge during these times. So give some advice, E, and then we'll wrap up.
Yeah, I mean, what I believe personally is that in terms of where to invest, I would say investing in e-government will probably be what I do, because governments are going to be the ones who have the most potential to really scale the use of technology, and now they have a use case for it. And the way I would do that is through what we've mentioned earlier: build the most efficient charter city in Africa, fully self-governed by leveraging the SEC mechanics. And then there you can build an island of isolation where you're basically an efficient government entirely running through e-government services, and people can stay in quarantine for the rest of their lives. And I think even now more so than before, it would be kind of the right kind of investment, because naturally capital from all over the world and all over the continent will flow there, and innovations will flow out. That's my belief. But that's my cookie idea. No one's going to give me $100 million. I'll probably have to use my money to do it later. In terms of where to start, I think angel investing in these times can look easy, but I think it's important for you to work with an experienced investor who's been through many downturns, because many people imagine angel investment is a set it and forget type of investment, but it's a lot of work. It's a lot of work that even our big fund managers sitting on hundreds of millions of dollars don't like to do. They just rather kill companies. So I would say, my own advice would be work with a collective like ours, work with existing angel investors, ignore the LPs. For more investors who are experienced, ignore the LPs. They're going to constrain you from investing when your companies need it the most. Ignore the investment committee. They're scared. They can't invest in these times, and it is our responsibility. Society has entrusted us with the responsibility of funding the future. It's not just about us being there in good times when valuations are going up and up. It's also about being a good fiduciary, not just to our limited partners, but to society, and funding innovation that can get us out of this crisis and back to a new semblance of money. So for us, what we're doing with the Future Collective is giving people an opportunity to partner with us to invest in startups. We don't want to go the route of LPs and ICs that don't understand the problems we're solving. We want you to partner with us to solve that. And we just put out an article today, future.africa/home/fund the future. You can join us and fund the future as well.
No, thank you both, guys. I mean, it's really, obviously, this is just a small snippet of the conversation we could have. We didn't really talk on debt funds, the importance to get credit into the region right now, as all these entities become really cash starved, and they don't have the SBA and $2 trillion of money stimulus coming. So we weren't able to get to a lot of things, but we got at least some engagement back and forth, and I hope we answered some of the questions of the audience. And I'll turn to Sandrine, but the idea is that we'll continue to do more of these while the Invest Africa network is unable to do physical events. We're forced to innovate as well. So thank you, Sandrine, for coordinating, and I'll turn it to you now.
Of course, and thank you all so much for all of your insights. As Aubrey mentioned, we're just looking to continue the conversation. I dropped the link in the chat for future webinars and future events. Hopefully we'll start to have some more of those in-person events as all of this dies down in, let's say, Q3 or Q4. But in the meantime, we're hosting podcasts, we're hosting webinars that are very similar to this, looking to really engage our community, bring the investment perspective, as well as the founder perspective to all of you. So thank you all so much for your questions. I see that there was a lot of questions that went unanswered, a lot of questions specifically about manufacturing. Our next Invest Africa US webinar will actually be hosted at the end of April and will feature Bayless Funds, one of the co-founders and partners, Franklin Amu, who will dive a little bit deeper into industrialization and manufacturing in Africa. So again, thank you all so much. Thank you, Rob, Aubrey, Iyin. Please stay safe and healthy. And we look forward to convening in the future. Thank you, everyone, for joining.
Thank you.
Thanks.
Thanks so much.
Bye.